right, the floor is yours, Alejandra.
Great, great. Thank you so much. What an amazing introduction. You definitely set the standard very high. So hopefully you all listeners enjoy the presentation today and that I keep it helpful and exciting. I'm trying to move the screen, but it's not. Oh, okay. So a little bit of a delay. All right. Just to kind of give you just a little bit of background about Ned Davis research, just more so it gives you an idea of how I will go through the presentation and sort of our approach. We look at a lot of different disciplines when we approach research. We look at macro, we look at fundamentals, we look at technicals, we look at sentiment. Now, because I am the chief economist, the vast majority of this presentation is the macroeconomic story. But I do sneak a couple other charts from these other disciplines, so just so you can get a total idea on how we view things broadly with our market views. But just to kind of give you an overview of what I'll discuss, I'll start off with the global economy, where we are in the global economic cycle, and then apply it directly to markets, because that's sort of why we're here. That's sort of what matters. How does the macro, why is it important for markets? What are the indicators we're looking at? Then I'll talk a little bit about inflation, very hot topic. Where are we now? How have we improved over the past couple of years? What's the long-term story? What's the end game with inflation? Are we going to get back to the inflation we saw before the pandemic? And then I get into a little bit of deep dive on the US and Chinese economies, just because they are really the big players in the global economy. So it sort of shows you how, kind of gives the explanation behind that broader global story. And then the last section is really discussing those long-term themes. What are the things that are going to set different countries apart in the long term? So I discuss it in the context of trends in globalization or deglobalization, who will benefit, who will be the winners, the losers. I've also done a lot of work on demographics over the years. One of the few things you can actually predict pretty accurately 10, 20, even 30 years down the road. So kind of compare some trends there. And then also discussing a long-term concern that we get a lot of questions about is US fiscal challenges. What's the end game with that? Oops, I'm a little, okay. I always like to start off with the bottom line. So essentially to give you the answers and then provide the supporting evidence throughout the presentation. So just to kind of go through that, global economy, we have been seeing some signs that it's been slowing, but we're not really seeing any compelling evidence that there's any signs of recession. And what you'll see in the charts, this supports a continuation of that bull market we've been seeing in global as well as US equities. We've seen global inflation rates fall quite a bit, but we do think that the post-pandemic world will likely see slightly higher inflation. Looking at the large economies, pretty clear to us that the US economy is avoiding recession. I'll show you the indicators we're looking at. China was kind of slowing a little more than we had hoped or had anticipated, but we saw a lot of brand new stimulus, which increases the chance of it reaching its growth goal. And then finally, at the end, these globalization demographic trends will sort of be our destiny and kind of determine some long-term outcomes. So first of all, now to show you the evidence, first chart right here, this is looking at the global economy. And I love this indicator. This is an indicator called the Purchasing Managers Index. It's a monthly indicator. It's actually released in a pretty timely manner. So we'll actually get data for October, so the current month we're in the first week of November. And for macro data, that's pretty early. That's pretty spot on. And this composite index looks at both the manufacturing and services sector. And overall, it's just a great monthly proxy for global GDP growth. And so the way this index works is if you have a reading above 50, it's an indication that the global economy is expanding. So if you look at the latest number, it's 51.99, pretty much 52. So it's showing us, pretty firmly that the global economy continues to grow. These vertical shaded lines are OECD defined global slowdowns, and you tend to see this indicator dip below 50 during global slowdowns, and we're not there. But if you look at the data, the first half of the year, which was depicted right here, was better than the second half of the year. So the fact that this indicator has been falling, it's been telling us that growth is positive, but it's just not quite as positive as it was in the first half of the year. And so it's always something that we need to watch out for to see if it actually gets worse. If you look at this next slide, This is looking at the sector that's causing that deterioration that we've seen in that overall composite. Unfortunately, it's manufacturing. Services sector has held up phenomenally well, not just in the United States, but also in Europe, relatively speaking, in China and Japan. Pretty much every country is seeing a reasonably strong or growing services sector. The manufacturing is we're seeing things lagging. So this is that same PMI, except it's specifically looking at the manufacturing sector. And as you can see right here, it's showing global contraction, not doing particularly well. And then what this bottom clip right here is showing you is it's showing you how broad-based that slowdown is. So it's essentially showing you that about almost 2/3 of the world's economies are experiencing contracting manufacturing industries. So it's not just one country that's driving it. We're actually seeing it across the board. So obviously some concern in that area. Another sort of downside risk to the outlook, so we talked about manufacturing, it's just policy uncertainty, right? So we have elections in the United States coming up, and there's always uncertainty associated with that. We have wars going on in various parts of the world, ongoing tensions with China, just even uncertainty about what the Fed will do in monetary policy. So what this chart right here is doing is it takes a concept like uncertainty, which is kind of vague, and it actually puts a numerical value to it. So what these people do with this so-called Global Economic Policy Uncertainty Index is they take mentions of policy uncertainty in major newspapers and sort of index it to a long-term average. So if the index is rising, it's a sign that, uncertainty, or at least perceived uncertainty, is rising. And so what we have it plotted against is global equities. So here we're using the MSCI All Country World Index. It's just the benchmark that we use. And we have it inverted so that you can see the relationship a little closer. And so what you find is that, yeah, they move hand in hand. But if you look at the correlation coefficient, this is just a way of being able to measure the fit of the indicator. And if you have a correlation of 1, that means the fit is identical. We have a correlation of 0.1 or 0.2 if you want to get close to that. So what it's essentially telling you is that this global policy uncertainty, not knowing where things are headed, it has some downside risk to global equities, but it's not the overlying determinant. Usually you need to see something rotting at the core. You need to see rising recession risk in some area. And then ultimately that global uncertainty, the wars, the elections, that's kind of like that one thing that can take you over the edge. So I think people often overestimate the impact because policy uncertainty can be a very emotional thing. But when you actually apply it to the data and apply it to markets, it's just a marginal impact. So just something that can explain some of the choppiness and volatility we can see in markets. This chart right here, this again sort of hones into that notion that things are kind of slowing, a little choppy, but not necessarily falling apart. And this is actually a seasonal indicator that we look at. So what this indicator is doing, and this is specifically depicted by this blue line right here. What we do every year at NDR is we create a roadmap of where we'll see US equities or the S&P 500 in a given year. And we create this roadmap simply by looking at historical averages. So we average together the 1-year cycle. In other words, what does typically equities do within a given year, right? There are certain, patterns you'll see throughout the year. We also put in the presidential cycle. So in this case, we are looking at the election year. So all election, the 4th year in the election cycle. And again, average those all together over the past 100 years or so. And then we also average in there the 10-year decennial cycle, all years ending in 4. Sounds a little weird, but there seems to be sort of like this mental reset whenever we start a new decade, and you often see repeated patterns with like end years. So this blue line would be what equities would look like this year if history were to perfectly repeat itself. Now, I wouldn't say drop everything you're doing and just look at this one indicator. That's not smart either, but it at least can kind of give you a guideline. And very often, at least from a directional basis, it tends to work. And what's rather interesting is a lot of what drives this year's cycle is the election. So you tend to get this uncertainty, right around this May, June period, partly because we don't know who the primary presidential candidates are going to be. This year, we kind of knew pretty early on. So I think we avoided some of that typical downside you get during election cycles. But then you tend to get some volatility around this, 3rd quarter of the year. But then you tend to get this year-end rally, incidentally, right around the election. Because the number one thing markets hate is not Democrats, not Republicans. They hate uncertainty. So once that uncertainty is resolved, you tend to get that year-end rally more often than not. And so we should be approaching that point, relatively soon once we get the results of the election. All right, so kind of showing you there's light at the end of the tunnel, right? So a little downside in the economy, but not falling apart, light at the end of the tunnel. We've got this possible, reduction in uncertainty associated with the election. And markets are starting to anticipate this. So another pillar element we look at NDR, and I showed that at the beginning with that little pie or that 360 approach, is we look at sentiment. And so again, one of the things we noticed, in the middle of this year was that global macroeconomic sentiment started to deteriorate. And you can see that by that orange line going down right here. But over the past couple of months, this indicator has actually flipped back up again. And many times what happens with macroeconomic sentiment is it tends to be a leading indicator to the hard data. And we get it with like a lead time also. Now, maybe the size of the swing may not be as large, but it is a good lead on a directional basis. And so we put these performance boxes at the bottom of a lot of our charts. And what they're essentially doing is they're telling you when an indicator is at a certain level, what does it mean for global equities? And so what this indicator is telling you is that when this optimism line is above this blue line, in other words, it's net positive, people are just net optimistic about the outlook, equities tend to be up about 10.3% per annum. So we often do that with a lot of our indicators is, hey, sentiment is macro sentiment is rising. That's a good thing. But we like to prove it to you that it looks good for markets and that it tends to have positive consequences on markets. So seeing a little bit of a light at the end of the tunnel there. Another positive aspect, definitely over the next year, but another positive element we're seeing in the global economy too, is monetary policy. So most of you probably know at this point that the Fed has reduced interest rates, did it for the first time since 2022. We love our easing cycles, right? And so one of our rules at Ned Davis Research is don't fight the Fed, right? Markets love easy monetary policy. We've found that historically. Well, because I'm a global economist, I like to expand the definition and say don't fight the world's central banks. So this is sort of a measure of that. So if you look at this orange line right here, this is the percent of the world's central banks. And I have about 40 developed and emerging market central banks in this reading that are in easing cycles. And look at the number. It's at 74. I was about to say 75, but 74%. It's a pretty big number. And we actually, the economy that took us to that above 50% mark was actually the Fed. And so many times, a lot of emerging market central banks sort of sit on the sidelines. They don't want to change policy until the Fed does. Once they did, it kind of snowballed to even more. But you had a lot of other central banks easing policy even before that. And again, we have these performance boxes on the bottom of the chart. And what it's showing you is that when more than half of the world's central banks are in easing cycles, and we're well above that, very different from where we were, say, in 2022, equities tend to be up about 9% per annum. So also a pretty positive indicator. And then just for fun, I wanted to squeeze in a technical indicator. This is not something I do as much work on as a macroeconomist, but other folks at Ned Davis Research who focus a little more on short-term market indicators focus on this sort of analysis called technical analysis, which is just price-based analysis. You're pretty much using the price and patterns within the data itself to create signals. And so what this chart right here is showing, this middle clip right here, this is looking at the percent of global stocks that are above their 50-day moving average. So we often call this a measure of short-term breadth. And as you can see, pretty strong. And then the bottom clip is looking at that same indicator, but looking at it relative to a 200-day moving average, which we typically classify as longer-term breadth. And, when breadth is mixed, it's okay for markets. When breadth is weak, when nobody's rising, it's bad for markets. But we're in a position now where breadth is strong across the board, which is also a bullish condition for equities. So you're kind of seeing that I'm sort of starting to build a case, right, for that bullish case. And then finally, at the end of the day, the most important takeaway is that global recession risk remains low. So I've showed you a few indicators to kind of show you why the global economy is in decent shape. But one of the things we do at our firm too is we don't just hang our hat on one indicator. We don't just look at one and say, hey, that's the only indicator we're going to look at to call recession, because you can get them wrong. I mean, some of the best economists have hung their hat on one indicator to make a recession call, and sometimes they don't work perfectly. So if you look at a lot of them, then you feel more confident about your call. And so what we have right here is this is our global recession watch report. And when we have 8 of the indicators hit a recessionary threshold, or what has historically been associated with one, we've usually been in global recession. And we're not even close. We only have one indicator that's flashing red, and it's one of those manufacturing indicators. As I mentioned before, that's just a part of the economy that's just been hurting over the past few years, since 2022. And that's just so important to know whether you're in recession or not. And it's pretty clear in this chart that I show you right here. And I love this chart. It's a very straightforward chart, but I love it because I think it just keeps you with a job. It shows you how important the macro story, the macro economy, the macro cycle is for determining whether markets will be in a bear market or whether they'll continue to move higher. So it's a very straightforward chart. The blue line is global equities, so the MSCI All Country World Index. And then these vertical shaded lines are OECD defined global slowdown. So they're just these sort of sharp, sustained slowdowns. And by simply looking at the chart, you'll notice that every single equity bear market, right? Every single large drawdown, every single end to that bull market has occurred in or around these global slowdowns. That's why I tell you, this is why macro is so important, because if you know you're in one of these global slowdowns, you can prevent quite a bit of downside risk. You'll also notice I made sort of a delineation with this light gray shading versus dark gray shading. So a light gray shading is what I would classify as a non-US caused global slowdown. So European sovereign debt crisis is a good example, Asian financial crisis. We had an emerging market slowdown in 2015, 2016, excuse me. In that case, you tend to get bear markets and equities. They're just not quite as big. I know any bear market sounds awful, but they tend to be more around that 20% correction size. The really bad bear markets are the ones that include global slowdowns with US recession. Hate to say this, and I'll say this to our overseas clients. We in the US, we like to spread our problems to the rest of the world whenever we have a crisis of any sort, because we're so financially integrated, and also because we're the world's largest economy. US-caused global recessions tend to be the worst ones. And as you can see, you tend to see the worst bear markets during those times too. And the good news is we're just not seeing evidence of either. And I'll show you more of that when I get to the US section in a moment. But before I go to that, I wanted to take a few moments to just discuss the inflation story. This is a big topic. I mean, this is something many of us hadn't seen either in our lifetimes or in decades, a really, really large spike in inflation. And the good news is inflation in probably most parts of the world are getting kind of close to central bank targets. It depends which measure you're looking at. Some are a little stickier than others, but we've really seen inflation kind of get back to normal. And so that doesn't necessarily mean that prices are going down to what they were before. It's unfortunately, prices usually don't fall very much. They can just, that pace of growth can slow. And so that's what I'm talking about, is that pace of price growth is getting back to what it was, or getting close to what central banks want, and getting close to what we saw before the pandemic, or even before the global financial crisis. And one of the leading causes behind the slowdown in global inflation has been due to these dislocations we had in the goods sector due to the pandemic. They've kind of fixed themselves. Those supply chain pressures, remember that was all the rage. Everybody was talking about them in 2022, 2023. So this orange line right here, this is the global supply chain pressures index. So this puts together shipping costs, back orders, all those different things that were creating all those different bottlenecks that we had in 2021, 2022. And it was an imbalance of supply and demand, right? We were buying a lot more stuff, and suppliers couldn't keep up with that insatiable demand. And they were also getting stuck with all of these, COVID shutdowns and all of that. So it just created this perfect storm of higher prices. So as a result, we've seen massive goods disinflation, which means, and in some cases, actually goods deflation. I told you earlier, we don't see deflation, but we actually have been seeing it on the goods side. The prices have actually been declining, and that's been helping us bring down that global inflation story. Now, you will notice if you look at this global supply chain pressures index, it tends to lead global inflation by roughly 9 to 12 months. And it has been starting to stabilize, kind of getting back to normal pre-pandemic levels. So it sort of tells us that, maybe we won't see as much good deflation anymore, but things are going to start to stabilize and get back to normal. They won't be as large of a source of downside. Where we are seeing continued inflation pressures, not just in the United States, but in also other parts of the world, is on the services side. But if you kind of look into the nitty gritty, this is what we economists do. We look at, well, what's the specific detail that's causing this? A lot of what's kept US services inflation strong is actually the housing market. We have the largest share of shelter in our CPI than any other economy in the G7. Europe doesn't even put housing in their inflation number because they think it's an asset. So sometimes it's very important to look at how things are actually calculated. But housing prices in the United States are probably going to stay fairly resilient. They stayed resilient when interest rates were rising because people had locked in such low mortgages. They weren't putting out existing home supplies, and that was keeping the market tight and kept prices higher than they would have. And then you add in the fact that we had a huge housing supply shortage even going into the pandemic. So, these are things that the Fed can't control, right? And then if interest rates go down, which they have already, and if mortgage rates go down, which they have somewhat, that'll get more people in the market, which would also drive up prices. So, it's just one of those things that's going to have a constant upside pressure. One thing we can see is that in the United States, wage pressures have fallen dramatically, and specifically a measure we look at that's called unit labor costs. And so unit labor costs not only look at wages, but they also look at productivity, how well we use them. So if you look at these unit labor costs, which are pretty much a measure of how well we're using our workers, they're the lowest in a decade. So you can't really make an argument that wages are causing inflationary pressure. But that can't be said in the Eurozone and in the UK. They're still seeing relatively strong wage pressures, but extremely low productivity. So overall, different countries are seeing sticky services inflation, but for slightly different reasons. And then finally, the more interesting, or just kind of the long-term story, because I'm also here to talk about long-term cycles, is what's the end game with inflation? Are we going to end up with higher inflation than what we had before the pandemic? And I think we will, slightly on the margin. But sometimes it's important to sort of step back and think about, well, why did we have low inflation before the pandemic, and will those elements actually stick around? So if you look at this chart on the left, this is just looking at developed market inflation, and this is the growth. And you can see it's been in a downtrend for a very, very long period of time. I mean, this isn't something that just happened overnight. We definitely saw quite a bit of a down leg and sustainable downside with globalization, with China joining the World Trade Organization in 2001. And you can argue this spike that we got right here was because of the pandemic. Had we not had that, we wouldn't have seen all those goods dislocations that I talked about before. So sometimes it's important to step back and think, well, what did the pandemic change? How will things go moving forward? So I'm not going to go through every one of these secular factors that I have listed here, but I'll touch on a few that I think are important to keep in mind. I think technology is a pretty big one. And if anything, I think technology may improve and be even more disinflationary going forward. We've seen a big productivity boom in the United States because of our labor shortage. A lot of businesses had to get smart about how they use their workers and training. So the result has been actually quite great from a productivity perspective. But the artificial intelligence could potentially make us much more productive. You won't see that a whole lot in the data now, but maybe in the next 2, 3, 4 years. And when it comes to technological adoption, the US is usually one of the first economies in the world to pick it up. So we'd likely see it here first and then in other parts of the world. So this could actually be very disinflationary. Globalization, this is something I'll talk about a little later on, but globalization is something that is becoming less disinflationary as you start being a little more choosy about who you're going to trade with. So I'm not going to trade with this country because we don't have good political ties with them. I'm going to limit my scope. You are going to see higher inflation, unfortunately. So that's something that I think is here to stay. One last point I just wanted to make was this notion of well-anchored inflation expectations. I do think that the pandemic may have changed this, because think about it. Before the pandemic, we had been used to so much low prices and deflation. You were seeing businesses that were actually making their products lower quality in order to keep the price low. We were not accepting anything lower. Whereas the pandemic kind of got us used to accepting high prices. I have my sushi restaurant down the street. They keep on raising their prices and I'm like, I'll keep on getting it, right? You just sort of go with it. So maybe we won't accept that 10% or 9% or 8% price increase, but I think we're going to be more susceptible to accepting higher prices than we did before the pandemic. And there was a bit of a mental reset with that. All right, so just a few thoughts on the US economy. You know, as I mentioned before, when you want to look at cyclical bear markets in equities, like those really, really bad bear markets, you tend to get a sharp drawdown when the global economy is in, you know, sort of a bad economic scenario, but you get the really, really bad bear markets or equity downturns when the US economy is in recession. And so I showed you our global recession watch report. This is our US version. It has totally different indicators, but it's giving pretty much the same signal. Yeah, we're seeing some weakness on the manufacturing end, but overall, there's really not remotely enough evidence to call US recession at this time. Again, kind of looking at a lot of indicators at once can keep you very disciplined. Now, we have seen some elements of the economy slow, or if anything, you want to say become more balanced. So I'll have a lot of people ask me, you know, where is the job market headed? Is it weakening? Now, we did get a good number in September, but prior to that, we were seeing just broad-based signs that things were weakening. But at NDR, we were viewing it more in the terms of the labor market was just becoming more in balance, right? After the pandemic, things just got really, really crazy. We needed workers and, you know, people were desperate to get their hands on who they could. And it just created this really distorted labor market. And we're now just sort of getting back to normal. So one indicator I like to watch closely, and this is actually one that Jay Powell from the Fed has mentioned quite a bit in his speeches, is the job openings to unemployed ratio. So it's just a really good way to gauge how many job openings they are relative to the people who are looking for work, right? And as you can see, the number is down significantly from its peak that we got in 2022. But you compare it to past recessions, pandemic's not a good example because that happened so quickly, but usually you tend to have more unemployed per job opening. In other words, this number tends to be well below 1 when we've been at the brink of recession. So we're not even close to that. To me, it's just more, you know, more of a matter of the labor market just becoming a little more balanced and more of where we need it to be. And then I think another really important element to keep in mind too is, again, monetary policy. I keep on sort of putting that in. You know, we have these charts right here that show that whenever the Fed has engaged in an easing cycle, or in other words, has cut rates for the first time, the economy tends to do well after, right? You would think so. That's the whole point of what they're doing, right? But if the economy, the US economy, is not in recession, you don't even get a little bit of downside. It's business as usual. The economy tends to do well. So if you look at this chart on the left, this is looking at the coincident economic index. It's just a monthly proxy for US GDP. The red line is what happens when the Fed engages in a rate cut and there's no recession. Just keeps on going higher and higher. So this vertical dash line, this is the Fed rate cut. And then this line is all of the historical examples of that happening. If you look at the chart on the right, this is looking at the exact same thing, or the exact same like analysis, but looking at it from the job market, so specifically payrolls. And again, when the Fed engages in preemptive rate cuts, in other words, they engage in an easing cycle before the economy has fallen to recession, they're not too late to the game, you tend to not see that much, if at all, any economic damage. And I think a lot of the reasoning for this is those animal spirits that get you, you know, excited by cheap money or lower interest rates. They're still there, right? Once, if you offer cheap money during a deep recession, you're not going to take them up on that offer. You know, a good example of that was during the global financial crisis. So it's always smart for the Fed to be preemptive, and we seem to be with that scenario based on the data we're looking at. And then this chart right here, this is just looking at different growth and inflation scenarios and what market performance means with that. Again, just to hone in that point that we're overweight equities is for now, we're in this strong growth, low inflation scenario. And historically, that's actually been one of the best periods for US equities. And so we have all these other examples here. Stagflation is the worst one. Some people wonder why recession is positive. One of the reasons is because markets tend to predict the end of recession before it actually ends. And the most bullish portion of a bull market is that very early stage. So if you look at market performance throughout an entire recession, it actually tends to be not that bad because you're getting that early stage of the bull market. So nice food for thought there. All right, so just to kind of hone in on a few points on China, again, world's second largest economy, has a very, very large influence with the world. I don't know if you guys have been watching the data, but China's economy has been slowing quite a bit, slower than what the government has wanted to, and slow for Chinese standards. Like GDP growth is still over 4.5% year to year, so it's still higher than what you get in the United States, but it's slow for Chinese standards. So in China's usual manner, if they're not going to meet their growth goal, which is 5% this year, they jumped in with a stimulus package and they're just going to get growth to where it needs to be. And that's sort of the way China has always worked over the years. They don't try to overstimulate. They haven't done that since 2008-09, but they try to get you to where that growth goal is. So, overall, shouldn't be too worried about the intermediate global economic story because, as I mentioned, US economy seems to be in pretty good shape, very low risk of recession. And then obviously China is kind of keeping its growth path going. To me, sort of the more interesting story with China is its long-term story. And one way to sort of depict this is by looking at its potential growth. So this is its best growth given its inputs. This is a really good, sort of indicator of, where an economy is going to be on the longer term. And potential growth is, there's different ways of calculating it. We kind of do it in this quick way where you add up labor force growth, your people, plus productivity growth, which is how well you use your people. You just add up those two growth rates together and you get a potential growth, the best possible sustained GDP growth you can have. And we have that estimate for China right here. And I think some people are surprised to see that China can only grow at less than half the pace it was growing in 08-09. So its potential growth has fallen dramatically. And this is corresponded with the relative strength and its equity market performance, which is shown in this top clip. Don't they look pretty similar? Totally different series. And so the question is can they turn those things around? Can you get that orange number to go back up? Because after it's been going down for a long time, it's hard to turn that around. One reason is just China is now more developed than it was 10, 15 years ago. So that economic catch up from technological change, it just can't do that as quickly as it did before. But there's also a lot of other factors. Deglobalization away from China. That's not good for the economy. It's large real estate market. That's also not good for productivity. It actually has one of the highest debts, non-financial debt in the entire world as a share of GDP, not even compared to emerging markets, actually in the entire world. And again, that's not good for productivity. And then the big kicker is actually demographics. China's labor force has been shrinking since 2018. It's been shrinking every single year since 2018. Holding all else constant, that literally pulls down economic growth. In the United States, we still have pretty robust labor force growth. So we're in a totally different situation. So it's just hard to see whether this could be sustainable. So obviously, I'm not super positive on China in the long term. So other little tidbits I wanted to point out that reflect long-term themes, just for the sake of time. I put this section on globalization right after China because I think it really relates well to the China story. So if you go back and you look at global trade volume, so this is just how much stuff is being traded from country to country over the years. If you look at data since, say, after the global financial crisis in 2008, 2009, global trade hasn't been as strong as it was before then. So I think there's been generally this call by a lot of economists that we're seeing deglobalization. So I wanted to see, well, who's causing that? Like, who's trading less? So if you look at this chart on the left, what we did is we looked at imports plus exports on a real basis, so adjusted for inflation, as a share of GDP. So just sort of a proxy for trade's importance in an economy. And I have the world's largest economy. So most of them are G7 economies, and then I have China in there. And what you'll notice is that pretty much every economy, trade has become either stayed just as important or has become more important. The one exception is this blue dashed line. And guess who that is? That's China. So trade is about half as important as it used to be in 07, 08, believe it or not. They're the cause behind the falling trade volumes. They've been becoming more self-sufficient. And the reason for this is they've internalized their supply chains, because the way trade works is that no matter what form it comes out at a country, it becomes, even if it's an input or a final product, it's a trade transaction. But if China's producing everything, in its own country on its own, and it's not doing that back and forth, producing, an item, a little bit here, a little bit in the United States, a little bit in Mexico, sort of jumping around, that's literally reducing trade volumes. So China's really been the cause of it. And then the chart on the right is just showing you how trade has diversified in the United States versus other countries around the world. When we saw Trump engage in tariffs in 2018, and then they've been continued under the Biden administration, we have seen US trade ties with China fall, but we haven't necessarily seen our trade balance become wider or, go into surplus category. Because what we've essentially done is businesses want to make money. So if it's too hard to do business in China, they're going to go to the next lowest cost producer, which likely isn't the United States. And so we've seen trade flows instead move to USMCA, so Mexico and Canada. They're now our largest trade. Well, actually, we're close to it anyway, but have become pretty large now, to Europe, to Southeast Asia. So, kind of a difference in trade, but not the end of it. Excuse me. And then another point I wanted to make is, we engage often in international trade or global trade because we want to take advantage of robust, younger, and cheaper labor forces in other parts of the world. And there's often a correlation with the number of people, right? Usually when you have a lot of people, you're able to get them at a good price. And if you look at this chart on the left, the demographic situation is very different in different parts of the world. So if you look at this chart on the, if you move further to this side, what this is looking at is this is looking at the growth of the working age population for economies all over the world. And look at China right here. Outright decline. It's working age population. This isn't total population. This is working age. It is set to decline around 10% over the next 15 years, where you're seeing a lot of the demographic growth in the future of the global labor force. It's in sub-Saharan Africa, it's in Latin America, it's in South Asia, it's in Southeast Asia. You'll also notice that the United States has a pretty big portion right here too. So we're actually on the positive side of that demographic spectrum, which often tends to surprise a lot of people because most developed markets, as depicted by this green right here, tend to be on the negative side of things. So holding all else constant, we're actually quite well positioned from a demographic perspective. And looking at a few just sort of side concepts from demographics, so we look at it from a global perspective and the relative trends, and you can see a lot of the upside could be coming from the United States. Australia was in there as well, and then those Asian economies, Latin American and African economies I mentioned. But just to kind of hone in on a very specific development that perhaps came as a result of the pandemic, is we saw a huge surge in female participation in the workforce. It was an unexpected upside. And you can see this in the chart on the left. It happened all over the globe. So orange is the jump in the female participation rate compared to pre-pandemic. And then blue is the male counterpart. So very, very different story. And again, this was seen all over the world. And I think a lot of this had to do with the way in which we changed the way we work. We have more flexible work environments. And I think usually you tend to see more females working and having children whenever there are more flexible work environments. So this, unexpected change kind of helped more female participation, which at the end contributes to the labor force and potential growth. In the United States, in particular, we've seen a huge jump in millennial women. And again, so this is 20 to 34, 35 to 44. So again, that whole notion of flexibility and being able to sort of juggle family and work has really been quite positive for millennial women. And if you look at this is just looking at the change compared to pre-pandemic, but if you look at the actual level, it's the highest ever. It's the highest on record. This is going back to data in the 1940s. So pretty interesting development. And overall, that's actually a really positive development for US demographics and US equity markets, believe it or not. So this chart right here, this is a way that a lot of us economists have been able to quantify the impact of demographics on global or on US equities. So specifically, we're looking at the Dow Jones Industrial Average just because we want more history, and we have it inflation adjusted. And so the blue line is a demographic ratio that actually has a good forecasting ability, or can kind of pick up long-term trends in equities. And so what the ratio looks at is it looks at the ratio of the maturing population. So these are folks relatively ages 30s through 50s versus the younger population. So these are usually people in their 20s through early 30s. And if you have a large proportion of people in their late 30s, 40s, 50s, compared to that younger population, it's actually good for equities. And if you look at right here, that ratio is actually expected to increase through the middle of the next decade. And what's causing that is that millennial population, because I think a lot of people don't realize that the millennial population is actually bigger in size than the baby boom population. And they're going to create this positive demographic tailwind over the next few years. They're getting older, right? They're getting ready. They're making more money. They're becoming more productive. They're starting to realize, oh, I need to put more money on my 401k. Well, if you've got more people doing that, that tends to bid up prices too. So this is kind of a really nice way to show those demographic developments in the United States coupled with the increased female participation and actually apply it to market. So nice, rosy, long-term bullish view. And then I have to stop you. I have to nip it in the bud, right? Because we economists do that. We like to shower you with good news and then just pull you back and tell you, no, don't get too excited. Because one of the issues we have in the United States is we do have fiscal debt challenges. One of the things that we're very close to being number one in is having the highest government debt as a share of GDP. Holding all else constant. Again, there's a lot of other things going on. I'll talk about that in a second. But yeah, that will lead to higher interest rates in the long term, crowd out private investment because you have to be able to pay back that debt. And a larger and larger share of fiscal spending is strictly going to go to paying off the interest owed on that debt. And that's not fun debt to pay off, right? I like to show this chart on the right because this shows you this didn't just start. This is something, the high debt in the United States has been accumulated for several decades by every single presidential administration. So this orange line right here, this is the US deficit as a share of GDP, and we're comparing it to other countries in the G7. And pretty much since 2000, we've been number one almost every time across the board. So overall, that accumulates, and that leads to our pretty high level of debt compared to the rest of the G7. Funny enough, we shouldn't be in this situation. One, if you look at the chart on the left, we actually have the smallest government. So if you look at revenues and expenditures as a share of GDP, we have the smallest in the G7. Problem is we just can't balance it very well. Other countries spend more, but they also get more in revenues and create sort of a better balance. So that's sort of what's been our issue. Another thing that why we shouldn't be in this situation is we also have the fastest growth potential. So if you look at this chart right here on the right, what we did was we calculated that potential growth. Remember, I talked about that before, that labor force, that productivity. We calculated that potential growth and we're comparing it here among G7 economies. And look at the United States. No one can grow as fast as we can on a sustainable basis. Again, we have that great productivity. We have that great labor force. Some countries here actually have negative potential growth or close to it, around zero, just because their demographic and productivity situation is so weak. So we shouldn't be in this situation. And I think if you look at us from a relative investment perspective, this in a sense sort of offsets some of that downside risk one can see from the high debt situation. And then final slide I have here, I think many times a question we get is, well, if the government has extremely high debt, is no one going to believe in the US economy anymore? And the dollar loses its position as the world's most actively used currency. And my answer to that is changes like that take a very, very long time, can take sometimes up to 100 years. And two, there's no good alternative. And so just to show you how deeply embedded the US dollar is in all of our global day-to-day transactions, says it no more clearly than this data right here. So this is data from the Bank of International Settlements. They put out this data every 3 years. It's a survey of foreign exchange transactions as a share of total foreign exchange transactions. It's pretty much how trade, every single transaction we're doing globally. And so because for every one currency transaction, there's an opposite transaction, this total should equal 200%, right? Well, if you look at the United States or the US dollar, it was used in 90%, nearly 90% of foreign exchange transactions. That's pretty much all of them. There's only 10% that weren't used with the US dollar. And look who came next, the euro. It's probably not going to replace the dollar. After that, the yen. That's not going to replace it. They have bigger problems than us, bigger debts, like double of ours. The Chinese yuan, yes, its share has risen, but from 0 to a whopping 7%. It's not even close to these other economies. And then you've got like this set of other ones. And, you can try to think of other monetary alternatives. Often people say gold, but we abandoned the gold standard because there's just not enough of it to substitute fiat currency. You often get questions, well, is Bitcoin a possibility? Possibly, maybe very, very later down the road. But for now, you need to adopt one that we're comfortable with. And I don't think Bitcoin is really money. It's an asset. It's not a medium of exchange. It's not a good medium of exchange. It's not a good store of value. So it's probably not going to replace any of these things anytime in the near term. So that is it from me. I think we have a little bit of time for Q&A.
We do have time as long as you are willing to share.
Absolutely.
We don't have to cut at exactly 1 o'clock. If we like doing this, we can go maybe 5-10 minutes as long as we have our clients interested. So you actually touched on a lot of the questions that we got. So you can, if you like, keep your answers short or as detailed as you want. So the first one is obviously the elections is in everyone's mind. You kind of painted a positive picture, economy, easing cycle, bull market, all kind of point up, but then we have elections coming. So what are your thoughts on that? How will the elections affect the economy?
Yeah, no, it's a good question because I think ultimately it's the outcome, what's going to happen with it. So we've kind of tried to sift through all the different policies that both candidates have proposed. And I think the bottom line is they're both very expansionary. But both want to increase spending and neither wants to really increase revenue a whole lot. So overall, on balance, it's expansionary. Holding all else constant, that's just another element to add to the positive growth picture, right? If the government's spending more on balance, they're not increasing taxes a whole lot and they're still spending more, that should help the economy. It could also boost inflation. So kind of gets us back to, I don't know if it would get us back to where we were before, it definitely won't, but does create demand-driven inflation, right? Because if the economy is doing really well with the Fed policy and the fiscal policy, that could be expansionary. If one of Trump's policies is broad-based tariffs, when you see what we saw first time around where the tariffs were a little more localized, it doesn't have as much of an impact on inflation because you can just go someplace else. But if you do broad-based tariffs, we don't know if he will, but he has proposed that as an option, that would also be inflationary, but more from a supply cost perspective. And that's usually not the kind of inflation that we want. Now, I think a really important thing to keep in mind is Congress, because if there is a clean sweep, and there actually are scenarios that show clean sweeps both ways, right? All Republican House, Senate, President, all Democrat House, Senate, President, then any clean sweep would be more expansionary, right? But interestingly, I didn't talk about this in my prepared remarks, but actually the best period for equities is when you have a check on power. So in other words, have like a Democratic president, but with a mixed Congress. And it's because a whole lot of stuff doesn't get done and there's less uncertainty and you tend to get, less inflationary pressure and the fiscal situation doesn't get as bad. So we in the market world often kind of hope for that mixed environment because then that gridlock tends to lead to less change. And then, as you mentioned before, it's not just elections and government policy and policy uncertainty, which I showed earlier. Those aren't the only things that determine market performance. I think we give our government officials a little too much credit. It's definitely a broad array of factors, including Fed policy, geopolitical risks, and what the global picture is as well. So important to keep all those things in mind.
For next year, who do you think will outperform, US or international?
So at NDR, we tend to get a little more detailed and we look at things more from a 7-way regional framework. So we look at like emerging markets, we look at Japan, we look at Europe. And so many times we'll recommend just one region over another as opposed to making that international versus US call. That being said, we are overweight the US. I would say in the long term, I also think the US, you can see some parts of outperformance in the developed world internationally here and then. But when you look at the potential growth story, which was that chart I just showed you previous to this one, the US is just relatively so much stronger, which argues for longer term outperformance. There's just more possibility here. And then I also see some sort of, again, in the longer term, see some more pockets of upside, and a lot of those economies that could benefit from that deglobalization away from China, and who also have very young workforces and, pretty decent running political systems and manufacturing sectors. So this would be economies in South Asia, Southeast Asia, and even some economies in Latin America. So not necessarily making a blanket emerging market call, but maybe picking a few specific ones that are benefiting from these new global trends.
How about the debt situation, growing US and consumer debt?
Yeah.
How can that affect the market?
Yeah. So if you look at any debt on a nominal basis, it just continues to rise and rise. That's always how it is. That's just the way developed economies work. So we like to look at debt as a share of GDP because it kind of normalizes it, right? If the economy is growing faster than the debt, then that ratio falls. That's a good thing. And that's actually been happening to the consumer since the global financial crisis. In fact, our household debt as a share of GDP is the lowest since the early 2000s. So it's actually, been moving in a decent direction. If you want to think about how it affects the economy, one of the things I like to look at are debt service ratios. So that's, as the name implies, your ability to service that debt on a day-to-day basis, because if you can't, that's when you get economic demise. I mean, this is what happened in 2008 during the global financial crisis, was those debt service ratios surged so high, people couldn't afford to pay anything anymore. They couldn't afford to pay their bills. They couldn't afford to pay for their houses. And that's when you saw things really fall apart. And so what's rather interesting is you get stories in the United States that our debt ratios have gone up, our debt service ratios, and they have, because the Fed raised interest rates. But if you look at overall household debt service ratio, it's still very low by historical norms. And the biggest reason is our number one form of debt is mortgage debt, about 70–75%. And what did a lot of Americans do? More than half of them locked in, the homeowners anyway, locked in mortgage rates under 4% and are able to keep that for 30 years. I'll mention that to my international clients and they're like, that's so not fair, because there's no other country in the world that's able to do that. And so that's kept that debt service ratio, that ability to pay your day-to-day bills on an average basis, pretty sustainable for most Americans. Now, that doesn't mean that's the same across the board. People who don't own homes, people who needed to buy a car, so had to get a car loan when interest rates were higher, had to put things on credit cards, they are facing some pain, and we have seen an increase in delinquency rates. But the end game is, on an aggregate level, we really haven't seen any signs of it, just more in certain pockets of the economy. And because wage growth continues to grow strong, people are still keeping their jobs. And because the Fed is reducing interest rates, that should sort of reduce that burden over the next year or so. So again, you got an optimistic answer from me.
Okay. Federico, can you bring that champagne that we've been keeping for some time?
That little known fact, even if I say something pessimistic, I'll say it with a smile.
With a
So
smile.
don't let that fool you.
So some China questions for you. You may not be ready for these or have information, but
I'll try.
Because they're kind of specific. Can China produce enough food to meet its needs?
Oh, that's a good question. I think it wants to get to that point. I don't know if it would have enough. And it also depends, that this is my follow-up question, for how long. So one of the things that China has done, and initially the reason for this was to control inflation, because you may recall, I forgot what year it was, gosh, maybe it was 2015, 2016, there was a huge spike in inflation prices because of pork. Just a shortage of one particular, I think it was around that time, of one particular commodity. So China got burned by that. They don't want to make their people unhappy, because the number one risk to China is social unrest. Because if you don't have your people supporting you, you don't have that government. You don't have that whole system. It's gone. So the government since then has put in stockpiles, and they haven't just done it with food, they've also done it with commodities. So whenever it gets cheap, you can see it in the data, they import a lot of it, they stockpile, they hold on to it, and then when it gets expensive, then they sort of level off and start buying. So yes, they have means of domestic production, but they've also been collecting stockpiles over the years. So that's why I asked, like, what's the follow-up for the rest of their eternity if they were to not have any food access? Yeah, I don't think they'd be able to sustain that on their own, not without having to make major cuts. I don't think we could in the United States either, right? Or at least not eat the things that we want, but they could be able to sustain it for, I would say, a few years, maybe, just because of those stockpiles that they have. But yeah, it's a good question. I don't know for how long, but I think maybe longer than a lot of people think.
So China's appetite for Taiwan is one big topic in people's minds. So if China's growth is low, would China need Taiwan sooner or later for its economic stability?
So this is my humble opinion. And again, I don't know, right? But my view, and kind of using Russia as an example and the actions that they eventually engaged in, is if you have not much to lose, in other words, you've broken all ties with the rest of the world, you don't hold any dollar-based assets anymore, your economic growth has slowed to nothing, I think your incentive to bring on another country is quite high. So I think it's also, we got to be careful about completely cutting off ties with China, because they have too much to lose if they cut them off overnight. But if this is something that happens over time, I think it does potentially increase that risk. It's funny. It's such a polarizing view. I went to like this econ retreat a couple months ago, and it's Chatham House rules, so I can't say who said these things, but there were a few geopolitical experts that are very closely linked to, knowing what's going on in the ground of China, what's going on in the United States intelligence and that type of stuff. And there were two experts on China and Taiwan. And they had completely polarizing views on how things will go. One said, oh, an invasion is going to happen by, over the next 3 years. Another one said, no, not even remotely close. So it just shows you that just there's a lot of uncertainty behind it. Yeah, that could be one of those really big geopolitical risks that could, throw the global economy in a tailspin. Not many do, but that one would definitely be one, just because of the broad global ties we have to those areas and, the implications of it happening.
Before I ask my last question, I was listening to a military expert a few days ago on this issue, and he said because Taiwan is an island, the preparations that are needed to attack an island is very different than like what Russia did to Ukraine, just the border. And they can monitor how long, that preparation has to be and where they are in that stage. And in his estimate, his like the earliest crazy early possible date is 2018. So that's kind of like
or
that.
Not 2018.
I mean 2028. Sorry, 18.
Oh, 2028. Okay.
28.
I was like, oh my God, it happened.
But there you go. I don't need that champagne. I don't need it. So yeah, 2028. Sorry.
That would be the earliest. Okay, interesting.
That was the earliest estimate. So apparently, in his estimate, they actually kind of slowed down preparations. So anyway,
interesting.
Last question on global conflict as well, and then we'll wrap it up.
Common topic, yeah.
Israel-Iran or Iran conflict. If it worsens, do you think the energy market, if oil goes up to, I don't know, $200, $300, what are your thoughts on that?
Okay. Will oil go? Oh my gosh. Well, let's hope it doesn't. Yeah. If it were to go to 200, 300, pretty much all of our studies show it's not so much the level that matters, because we get adjusted to that. It's how quickly the changes happen. So if you have like a 20% change, that would be even more than that. What are we looking at? 150% change over a short period of time. That would, I'm pretty sure that could be pretty detrimental to both the economy and markets, just the shock of that happening. We often get questions. So that's an important thing to keep in mind, is how big the swing is. Now, if it's just a modest change upside, you think about it, how it affects the US economy, it's actually kind of a wash, because keep in mind, in the United States, the producers benefit from higher oil prices, and especially compared to the past oil crises we had way back in the day, we are now net exporters. So you even saw this after Russia's invasion of Ukraine. Yes, our oil prices went up, but they didn't go up nearly as much as they did in Europe. And so a lot of it is because we do have that energy independence. So that's a big game changer, and that's something that's relatively new over the past 15 or more years. And then in terms of how it impacts the consumer, yeah, I mean, obviously, if you have a big increase of 150% or something like that, that's really going to eat into consumer purchasing power. If it's a little smaller, most of the time we can absorb it. If you compare like our spending baskets today to what they were, say, 40, 50 years ago, when we had our last big oil crisis, we spend less on oil as a share of our total spending. We've become a richer country and we spend a whole lot more on services. So you're able to get a little more of a balance out of that. The other thing that it could impact is also inflation. So usually the Fed targets a core inflation level. So they take out food and energy prices. They feel those are too volatile. But what happens is if energy prices stay elevated for an extended period of time, then it impacts the way we think about inflation, impacts our inflation expectations, and then it becomes a self-fulfilling prophecy. So yeah, there's definitely a lot of downsides to it. And I can definitely guarantee you, if you get to 200, 300, I don't think that'll happen. That's not our base case, but that would be pretty detrimental to both the economy and markets.
Okay, well, thank you so much.
Thank you,
Alejandra. This has been great, at least for me. I always learn a lot from you guys. Okay, Federico, let's wrap it up.
Yeah, well, thank you, everybody. Thank you, Alejandra, again. That was very insightful. I think you had some great charts. Definitely did not expect a lot of the insights as it comes to the economy, labor participation. So we appreciate the insight. Appreciate you sharing some time with us. And everybody, hope you have a great night. And thanks for joining. Take care, everybody. Bye-bye.